The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Very good morning to all. It's Monday morning. You're watching Squawk Box. I'm Steve Sedgwick. You've got Karen Cho. You've got Arabile Gamede. And you've also got some headlines. So Chinese equities once again surging, well, on better than expected factory activity for September. Wasn't that much better. But anyway, even as the sector shrinks for the fifth straight month. Japanese equities moving in the opposite direction, seeing red, whilst yields jump on a stronger yen as the markets take stock of, they assess the country's new Prime Minister.
Volkswagen issues its second profit warning in 3 months and warns of further risks ahead, with the car maker locked in talks with unions over potential plant closures. UniCredit CEO Andrea Orcel and incoming Commerzbank Chief Bettina Orlopp reportedly set out their vision for the future of the German lender in a virtual meeting as speculation continues around a potential takeover bid.
Israel kills Hezbollah leader Hassan Nasrallah in an airstrike on the Lebanese capital, with the group and Iran vowing vengeance.
Good morning to you, and good morning to you, Arabile, and good morning to you, Karen, as well. Lovely to see you this morning. Let me get my first dose of cynicism out of the way straight away. The Chinese markets are absolutely surging. You're going to spend a lot of time on this in a few moments' time. And the headline from CNBC and our fantastic copy and everyone else is the data was better than expected. So I know you're going to do this in a moment, but the Shenzhen, for example, is up 9% on a 0.3% difference on a measure that is still in contraction. I'm sorry. All of you out there, I know you got to fill column inches. We got to fill 3 hours out here, for goodness me. But the fact of the matter is, this is about the momentum in the trade. It is nothing to do with the quality of the data and the thought that China is suddenly going to surge economically.
It's a trade flavour of the month. We've seen it all year, from the Mag 7 stocks to even the breadth that's now coming into the US markets, because I think a lot of fund managers couldn't stretch much more out of the Mag 7 stock. So what did we have this quarter? We had breadth that really came back into the mix across different sectors. Now, in terms of those Asian markets, I think you've got to be wary about the Japanese stock trade. That was the flavour of the month for most of this year. Now, some of that steam really coming out of that market because of what you're seeing in terms of monetary policy and even some of the political situation. But the flavour of the month is undoubtedly the Chinese markets now.
Totally. So we're agreed. There you go. It's a momentum trade, and we're yet to see whether the data means that the Chinese economy is about to surge. One warning for you: at the start of August, you had a wobble. At the start of September, you had a wobble. What does the start of October augur? Because, would you believe it? It's October tomorrow. Karen, back to the markets.
Yeah, let's just take a look at the reaction. We've seen monetary stimulus, fiscal stimulus. The market is responding across the Chinese boards. And you can see the Shanghai Composite already on a tear last week, the biggest gain since 2008. And you start off the week with a 5.7% pop. Typically, after you see a very strong reaction to the news flow, then some of the enthusiasm could just peter out for a bit. That is not the case. There has been more news flow, and the market is still moving aggressively to the upside. 3,200 plus, the level we've recaptured. Shenzhen, that is the market that is truly on fire today. Gains of close to 9.5%. I mean, a single day trade like that, it is stunning in terms of the moves you're seeing in this market. The CSI to 6.2% higher. Hong Kong market swept up in the euphoria. And don't forget, this is about property stocks that have been so beaten up. The market looking over those names at this stage, and you can see that area supported. But a lot of the liquidity injection designed to support stocks, don't forget, which is why you're seeing this green spread right across those boards in China. Let me take you more broadly to Asia and what we're seeing across the board. Japanese markets are closely looking at the politics over the weekend, and the appointment of the designated Prime Minister now seem as somewhat of a hawk, a monetary hawk, and whether the markets now see pushback against what has been a more dovish narrative coming through from the Japanese after they spooked the markets. So any change to that narrative, don't forget too that the ratcheting up in the yen. The strength we've seen there is undermining some of these stocks in Japan, despite a lot of fund managers thinking that would not be the case, thinking that the fundamentals were strong enough to push back against any strength in yen. That is simply not the case. And we are seeing some of those big exporter stocks suffer. The market 4.8% lower, Topix down 2. Cosby over in South Korea, that is on the back foot, the only market in the green. And this is a China link. It is the Australian market travelling up by almost 0.7%. The dollar trade. I mentioned some of the gyrations we're seeing around monetary policy, and this is genuinely having an impact. We're counting down to payrolls later on. Stateside, the market is looking for more confirmation as to what the Fed will be doing. Euro dollar is flat this morning. We're 111.63. Sterling on the front foot. Again, a lot of politics on this side of the world as we count down to the budget here. Up about a tenth on sterling dollar. Dollar yen, that is on the back foot. So again, more yen strength this morning. Dollar slightly firmer versus the Swissy, one of the safe havens. We are tracking the market reaction out of China and Japan. Sam is in Singapore. Kari and Lynn are standing by in Tokyo for us. Sam, let's get out to you first. Big market moves we're watching again. Just break it all down for us.
Very good morning to you, Karen. Well, Steve will be pleased to know that he's not the only cynic in town. Some are saying, well, they wouldn't want a bad performing stock market ahead of the 75th birthday of the People's Republic of China, would they? So there has been some suggestion, maybe the national team at work here, and you have got the yuan on course for now the best quarter since 2020. Even we're seeing reports that the state banks have been sort of stepping in to cap some of that appreciation, as we've seen over the last few weeks or so. But we are seeing Chinese stocks on course for one of the best months we've seen in nearly a decade. Of course, the best week last week we've seen since 2008. So we continue to build on that today. The market has looked past the more downbeat data that we've got this morning by the way of the private and the official PMI reading. So we got this as a package deal today because they're all off on holidays tomorrow. So what that is telling us is that we continue to see these sort of worrying trends within the sort of factory activity space with regards to the demand story and how that's sort of wreaking havoc for some of the factories, but also with the services sector side of the equation as well. That's been coming off, even as many out there have been really sort of counting on the consumer to pull the weight here. We're even seeing that services activity is pulling back too. So no doubt that this further confirms why we got the stimulus measures we got last week, why they're paying so much attention to this now and building the case for more support measures. Now, as far as what the markets and people that we've been talking to today about what we got from the authorities last week, because they came out again over the weekend with even more for the housing sector, following through with their promises, because remember the Politburo meeting, which was a bit unusual last week, the fact that they talked about the economy, did very much emphasize that more was going to be done to stabilize the housing sector. They did want to stop that downward trend. They're now actually going to be guiding the commercial banks to lower those existing mortgage rates. So that is something that investors are very much cheering today. So that has helped real estate stocks. I mean, if you take a look at some of those Hong Kong listed names, they are absolutely on a tear today, double digits. So that is very much being welcomed by the market. But the big question moving forward, as Chinese traders and investors go for their break, is will this continue? Once we start to see the transmission, once we start to see some of this actually translating into demand, we're probably not likely to see that until the last quarter, and that is going to be very much the catalyst for whether this rally can continue. Is this the kitchen sink? Well, some say it is from the PBOC, but others are saying that perhaps more can be done on the fiscal side, because we've got to remember that for now it's only been reporting from the likes of Reuters, for instance, who have been talking about the potential for a 2 trillion yuan issuance in government bonds to help with the fiscal spending. This has not been confirmed by the authorities, so it's a bit of a case of over to you, MOF. for some answers and whether that rally can be sustained post-holiday. Send things back to you in London.
Thank you very much for that, Sam. And we're going to have another terrific guest later on in the show to talk more about China as well. But in the meantime, big moves out of Japan. Let's get up to speed with what's taking place on the Japanese stock market. The Nikkei, as you can see, sliding in sizable declines here. We've given up 4.8% in session and perched just at the 37,900 mark. Topics also trading much weaker. The Japanese yen, look at that, we're 142. So we are seeing again more strength in the Japanese currency versus the greenbacks. A real challenge there. Let's get out to Lin and Kari and Joji. They join us live from Tokyo. Lin and Kari, you've been leading our coverage on the wash-up from the election. It does make you wonder whether we are seeing a transfer of funds now out of Japan into the Chinese markets, that the market is worried about the monetary policy situation in Japan and whether we're dealing with a hawk with the incoming Prime Minister.
Good morning to you, Karen. So much to unpack in what you've just sort of outlined there. But Kari, bring you into the conversation here. When you look at this market reaction, I think it's important to note that, when we got the first round of voting on Friday, Takeichi-san, who is far-right conservative, right, has been a critic of BOJ policy normalization. She came out on top. Markets reacted to that, kind of pricing in a Takeichi win. But in the end, we got an Ishiba win in the second round. And between the first round and the second round, the stock markets, the Japanese stock markets had closed. So this is a bit of catch up, isn't it, in your view?
I definitely think so. This is a knee-jerk reaction to the gains that we saw on Friday's session, because at the end of the day, Mr. Shigeru Ishiba, the incoming prime minister, hasn't really outlined anything new in terms of economic policy. I mean, if anything, if you were to latch on for something that he said over the weekend that would trigger some kind of move like this, it's probably the capital gains tax. He's floated that idea before, and he mentioned that over the weekend. So I think investors are a little bit spooked by that. Mm-hmm.
And let's also just talk about what we've seen in terms of the sector breakdown in Japanese stocks today. Of course, we have seen the yen. It was on the Takeichi win and her dovish view on monetary policy. It was at 146. It's now at around that 142 level. And we are seeing exporters, a lot of your semiconductor and tech stocks, they're getting hit really hard. The heavyweight Toyota down more than 7%, for example. And real estate stocks also getting hit. But the rare silver lining is, of course, in banking stocks. So is this also this repricing by investors here about what to expect from the Bank of Japan going forward?
Yeah, probably. And as you pointed out, we saw that big dip in the yen first initially, and now we've seen this 4 yen move in a span of, say, one trading day, which pretty much explains why we're seeing the exporters down across the board. But in terms of what impact this new cabinet, this new government is going to have, I think he's made it clear that when he comes in, he wants to make sure that reflation is top of the agenda. And I think he's sort of shied away from making any kind of comments about how he will or will not pressure the Bank of Japan. But I think given that we're looking probably at a snap election fairly soon, I think he's going to announce some fiscal stimulus measures, which kind of goes against what he's been saying in terms of fiscal consolidation.
Yeah, exactly. There is sort of, I guess, so much to unpack in terms of what he has said in the past, because we know that he wants to rein in the debt and the deficit. Of course, Japan, massive public debt issues there. And he has said that he supports monetary policy normalization as long as it's coordinated with the government. But then at the weekend, as you've just pointed out, on an interview with NHK, the public broadcaster, talking about the fact that he's putting together an economic stimulus package, and also talking about the fact that he believes that the rates should remain loose because the economic recovery is still quite fragile. So to me, it sounds like it really is the politics of the day kind of dominating here.
Yeah, I mean, it sounds like political machinations in full swing here. And I think October 27th is the day, you and I are thinking about in terms of the possible election. That's not far away at all. And I think ahead of that, they need to make sure that the public is on board. And the number one concern for the Japanese public is inflation. And I think any kind of stimulus or any kind of help to try and address some of the high price issues at the supermarket or utilities, energy bills, and so forth, probably top of the agenda when he comes on board.
And let's talk about tomorrow, because we know that, of course, he'll be sworn in and we will get the official picks for the cabinet, but already getting some names now coming through. It sounds like it's going to be quite a lot of experience across the board.
Absolutely. I think we're hearing that a lot of ex-ministers are going to be part of the cabinet. You have himself and 2 other ex-defense ministers part of the cabinet, probably, which I think also highlights his focus in terms of defense policy. He's talked about possibility of a realignment of the security balance here in Asia. I don't know how that's going to play out if we see, Donald Trump back at the White House or not. And I think wants to keep the younger Shinichiro Koizumi, who he ran against, very popular. Keep your enemies close. So it looks like he's going to be appointed the new guy in charge of election policy in the expectation that there's going to be a snap election fairly soon.
Yeah, so still a lot more politics, domestic politics to be played out here. Steve and Karen, back to you for now.
Thank you very much for that, Lynn and Kauri, much appreciated. I'm going to push on to the US markets and what we've seen over the course of the trading month. Can you believe September's almost over? But what we've had over the month, and not a bad month for technology, and those stocks have been out in front. If you look at the performance on some of these major boards, the Nasdaq trading higher by 2.3%, outpacing the S&P 500 and also the Dow. So technology names, FANG stocks actually decent performance for those stocks. FANG Plus stocks actually trading up about 4.25%. Let's take a look at that board. Don't forget there was a buying back of some of the semiconductors too. But what did materialize was a slightly mixed performance for the quarter and the month for the big name stocks. Nvidia trading up, Apple down, giving back territory, Microsoft in the green, and you can see up more than 2%. So it was patchy for some of those Mag 7 stocks. To the banks, much better performance though than what you saw in this sector. The likes of JP Morgan down high single digits, Goldman Sachs giving back just over 2%, and Bank of America on the back foot. Banks overall trading down roughly 2.8% on the KBE, so well and truly underwhelming the FANG Plus stocks. Let's get to Manish Singh, who's the CIO at Crossbridge Capital. Manish, we're looking to wrap up the month of September, and what we've seen even the latest quarter has been a slight breadth returning to markets on the idea that a soft landing can be achieved by the Fed. Is this the right trade, or investors getting caught out in some sort of a trading trap?
Well, I think it's the right trade, because if you look at the PC data that we got on last week, all the numbers are trending to 2%. And if you, in fact, we might have the PC year on year at 2% or sub 2% when the next reading comes, which will be just before the next FOMC meeting. Now, you'll remember Chairman Powell saying time and time again that he will start adjusting rates long before we reach his target inflation level, which is 2% on PCE. So, in my opinion, we are on the right track. Well, you never forecast a soft landing unless you get one, but I think we are on track to get that.
How are you thinking about some of the big technology names? I mentioned that some of the FANG Plus stocks did get scooped up again, but it was by no means a one-way trade. Some of the trades around these stocks were patchy. Investors were really picking and choosing, and a little bit concerned, I think, about some of the hyperscalers and whether they're going to keep on throwing money at the likes of Nvidia. What do you make of the Mag 7 and technology stocks?
I'm on the trade. I'm still long Nvidia and the chip stocks, and I will continue to stay that way. If you look at the consumer spending is strong. You saw the updated number. If you look at the personal income number, that looks very good. Earnings are coming through. So there's no reason for me to believe that one should be selling those stocks. And if you see the Chinese growth starts taking off, then that will be good news as well. Of course, the big elephant in the room is the US election and what the US policy will be towards China. And that will be something that one has to, but you can't plan for that now. You can just react to it. But purely on earnings number and growth number and consumer spending, I feel positive about the US equity.
Manish, lovely to see you this morning. Can I focus on China, if I may? Unbelievable rally, historic rally, twice as fast from 52-week low to 52-week high as pretty much the S&P's ever done. I'm grateful to you for that data in your notes as well. Momentum and liquidity are powerful forces, but are they going to be matched by underlying economic improvement on the back of these measures?
So I would say that that's what we have to wait and see. But if you look at the data, let's talk about the savings. The amount of savings that Chinese consumer and people have in the banks is huge. I think it's something like $20 trillion or something. That's because the Chinese, they save between 25 and 40% of their income. If you look at the consumer spending as a percentage of GDP, that is below 40%. in China. It is over 70% in the US. So there is a huge amount of room for these things to grow. And it won't happen overnight. It won't happen in a week or 2 weeks. But given where the Chinese equities were over the last 4 years, the earnings kept on growing, sales kept on growing, and the stock kept going down. So all you're seeing is more and more of that catch-up rally. Only 10% of Chinese people own equities. Now, if that was to grow, you're going to see a lot of these come. But everything comes down to consumer spending. If the Chinese government gets the consumer to spend more and they have the savings to spend, they don't have to borrow to spend, and that feeds into growth and feeds into equities.
Yeah, I couldn't agree more, but that's a huge if, and you're absolutely right, only time will tell. But the market isn't taking prisoners today, yesterday or the day before, or the last couple of trading days. The market is saying it is risk on. How far should our viewers go in terms of going long the Chinese market, or should actually they just stand aside because this is very, very dangerous and very, very volatile?
So I would say if you look at from valuation point of view, and if you're buying things in US and Europe, which are far more expensive on relative terms, then I don't think you're buying anything which is expensive in the Chinese market. Now, if you expect that you're going to make quick buck and you're not going to have any surprises, then I think that you have to be prepared for that. And the reason I say that, one thing you have to bear in mind, you will not have Chinese authorities come on camera and say things that they said last week. They find it very difficult to walk anything back. So when I see these things happening, there's a sign that you're going to see more of that. And we had this thing early in the year as well. With the Chinese policymakers, they always put the news out. It takes a long time for market to catch up. If you look at the market has been bottoming from early this year. But the bottom sometimes could be 6 months, 9 months, 12 months. And I think that we have seen that bottom. We are seeing a rise in that. How far it can go, there's plenty of room. How soon it'll go, that's difficult to say.
Manish, international money can be fickle. And if you look at the Japanese stock market by comparison today, some of the heat, some of the enthusiasm very much dissipating as investors focus on the strength in the Japanese yen. It's extraordinary because that story has been a known to a lot of investors, the potential for that to happen, yet they dismissed it saying, look, the corporate profitability story is strong enough on its own. Is that not the case today? Do investors need to be very cautious on the Japanese market now?
I think one has to be cautious, but if you look at there are only 3 central banks raising rates at this time, and Japan is one of them. Now, Japan has a huge amount of retirees or old people. I don't think they would like to see higher inflation or weaker currency. So I am of the opinion that yen could get stronger, which means that Japanese equities could go down. So I'm not hugely long Japanese market. Rather, I have look-back trades where I can benefit from short-term moves. But then we will see what the new elections are likely due, probably end of this month. We will see what the new government policies are going to be. And if they were to do any stimulus, then that would help the equity market as well. Now, the final point, if the Chinese GDP does well and Chinese growth does well, and Japan cottons onto that and they benefit from it, then who knows? I mean, the earnings are going to get delivered by the corporates and the stocks are going to go higher.
Manish, thank you very much for joining us. We're watching that market now down 5% out of Japan. You. Manish Singh with us, CEO at Crossbridge Capital. Arabile.
Well, coming up on the show, more bumps and a few detours really on the road then for Volkswagen as it issues another profit warning. We'll cross live to Aneta for the latest on that story. Plus, Chinese manufacturing data, that's still in contractionary territory, but markets continuing to rally on expectations of further stimulus. And we'll be discussing the trends from this summer's travel season with the CEO of Get Your Guide as Johannes Reck. That conversation is coming up at 6:30 BST.
Welcome back. Volkswagen has slashed its full-year guidance for the second time in just 3 months and is warning of further risks ahead. It comes with the German car maker locked in talks with union officials over staff pay and the possibility of plant closures in Germany for the first time in its history. Annetta joins us now in Frankfurt. Annetta, I get it. The unions have a job. Their job is to get as much as they can in terms of the best remuneration package for their employees. But is IG Metall just plain dumb I only ask that because they're asking for a 7% pay rise at a time when Volkswagen is on its knees. The German car industry is on its knees, and they're potentially going to have to cut tens of thousands of jobs. What planet is IG Metall on?
Well, actually, I think behind the doors they are open for wage cuts. That is at least what is rumored from the negotiations in Wolfsburg around Volkswagen. So that IG Metall, of course, is playing hardball now, as is the management. But there is openness to actually look into wage cuts because clearly the wages at Volkswagen are far too high, and also the whole package. What Volkswagen workers get is far too high. It can reach up to 36 days of vacation per year, just like as a reminder of how generous the packages at Volkswagen are. And that is no longer feasible in that world where competition is so fierce, and Volkswagen has a huge profitability problem and potentially even a survival problem, at least in the sheer size of the company. So what happens now is it's the second profit warning, as you were saying, in a row. And they are mainly citing or quoting China as a reason. And that is, of course, striking because they have a huge problem to sell their hybrid and electrified cars in China. And at the same time, the Chinese government is restricting the registration for combustion engines. You only, at least in big metropolitan areas, you only get an allowance to register a combustion engine by lot. So that is a huge dilemma for Volkswagen, and not only for the mass brand, but also for the luxury segment. There is an internal document which has been seen by Business Insider, and in that document they are showcasing how they want to get out of that crisis, and it is mainly on the back of their luxury or at least upper class segment. So they are expecting that the core brand will remain weak for the coming years, probably in terms of profitability, and only Porsche and Audi and Lamborghini and the likes of that are expecting to be in the range of mid-teens to 20% profitability margin.
Annetta, thank you very much for bringing us that story. Elsewhere, UniCredit CEO Andrea Orcel reportedly attended a virtual meeting with Commerzbank on Friday, including with incoming CEO Bettina Orlopp. That's according to Reuters. UniCredit is the German bank's biggest private investor, now having built a potential 21% stake. Manfred Knof is set to leave the role of Commerzbank CEO today, with Orlopp officially taking the reins. Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to CNBC.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabi Lekumete, weekdays on CNBC.